What if Bitcoin's biggest risk right now isn't regulation, volatility, or even price crashes, but Wall Street quietly reshaping it into something it was never meant to be? What if the same financial machinery that turned gold into a paper asset is already doing the same thing to Bitcoin, only faster and at a much larger scale? Caitlin Long believes that is exactly what is happening. She argues that while most people are watching price, leverage is building invisibly through ETFs, derivatives, and custodial structures that separate ownership from control. Governments, banks, and institutions can now gain Bitcoin exposure without ever touching the underlying asset. And that leads to the question most investors are not asking. When a system is stressed and trust breaks down, will you actually own Bitcoin, or just a claim that depends on someone else's balance sheet? Hello everyone, and welcome back to another podcast summary video. In this one, we break down Caitlin Long's recent appearance on the What Bitcoin Did podcast, where the conversation moves well beyond Bitcoin price and into the hidden mechanics of the financial system itself. Caitlin draws direct parallels between what happened to gold in the 20th century and what she believes is now happening to Bitcoin through ETFs, custodians, derivatives, and regulatory incentives. This episode is almost 1.5 hours long, but we've distilled the most important ideas into a clear, structured breakdown so you can understand the main points of the conversation without listening to the whole episode. If you find these summaries useful, please like the video, subscribe to the channel, and share your thoughts in the comments, because it really helps us bring this content to you every week. Now let's walk through Caitlin Long's case for why Bitcoin's real test may still lie ahead. Caitlin Long begins by grounding the discussion in history because she believes the past offers a clear warning for what comes next. She explains that gold did not lose its monetary role because it failed as money, but because it was financialized. Once gold moved into centralized vaults, paper claims began to trade far more actively than the physical metal itself. Over time, this created a massive imbalance, where there were far more claims on gold than actual ounces available for delivery. Caitlin points out that by the late 20th century, the gold market was dominated by futures, forwards, swaps, and unallocated accounts, all of which relied on trust rather than settlement. The key lesson she emphasizes is that price suppression does not require selling physical gold. It only requires creating enough paper claims to absorb demand. And once that structure is in place, price becomes a policy variable rather than a signal. According to Caitlin Long, Bitcoin is now entering a similar financialization phase, but at an accelerated pace. She highlights the launch of spot Bitcoin ETFs as a major inflection point, not because they bring new demand, but because they centralize custody and expand the creation of paper Bitcoin claims. While ETFs appear simple on the surface, Caitlin explains that they introduce layers of intermediaries, including custodians, authorized participants, market makers, and clearing mechanisms. Each layer increases efficiency, but also increases counterparty risk and leverage. She warns that most ETF buyers do not own Bitcoin itself. They own a regulated claim that depends on custodians, legal structures, and market functioning remaining intact. And in calm conditions, that distinction feels irrelevant. In stress conditions, it becomes everything. Caitlin Long is very explicit on this point. She argues that Bitcoin's core innovation is not price appreciation, but the ability to settle without intermediaries. Once Bitcoin exposure is mediated through custodians and financial contracts, it starts to resemble the very system it was designed to escape. She explains that rehypothecation, the practice of reusing collateral multiple times, is already creeping into Bitcoin markets through prime brokerage and derivatives. This means the same Bitcoin can effectively support multiple claims, increasing apparent liquidity while masking underlying fragility. Caitlin stresses that this dynamic works beautifully until too many participants demand delivery at the same time. At that moment, paper liquidity evaporates, and only real Bitcoin matters. A central theme in Caitlin Long's framework is settlement risk. She repeatedly returns to the idea that markets do not fail because of bad prices, but because of failed settlement. She contrasts Bitcoin with traditional finance, where settlement can take days, relies on multiple intermediaries, and can be halted by policy decisions. Bitcoin, by contrast, settles in minutes and does not require trust in any institution. But Caitlin warns that if Bitcoin is held inside the traditional financial system, it inherits the same settlement risks. During crises, regulators can freeze accounts, custodians can gate withdrawals, and contracts can be rewritten. And that raises a question she believes most investors are avoiding. When volatility spikes, will your Bitcoin actually move when you need it to? Caitlin Long also dives into banking regulation, specifically Basel III, and how it treats Bitcoin differently depending on custody and structure. She explains that Bitcoin held directly is treated far more harshly from a capital perspective than Bitcoin exposure held through certain regulated vehicles. This creates incentives for banks to gain exposure without holding the underlying asset. In other words, the system encourages paper Bitcoin over real Bitcoin. Caitlin argues this is not accidental, but a feature of how modern finance manages risk on balance sheets. The danger, she explains, is that systemic leverage builds quietly, and by the time it becomes visible, it is already too late to unwind smoothly. Caitlin Long is careful not to predict a specific catalyst, but she is very clear that stress tests are unavoidable. Every monetary system eventually faces a moment where trust is tested and settlement matters more than promises. She points to historical examples where capital controls, bank holidays, or emergency regulations revealed who actually owned assets and who only held claims. In those moments, liquidity disappears, and legal fine print suddenly matters. Caitlin believes Bitcoin will face a similar test, not because it is flawed, but because its interaction with legacy finance introduces vulnerabilities that did not previously exist. One of Caitlin Long's most important clarifications is that self-custody is not about ideology or purity. It is about risk management. She emphasizes that custody choices determine whether Bitcoin functions as a bearer asset or a financial product. Holding keys removes counterparty risk, but it also requires responsibility and operational competence. Caitlin does not argue that everyone must self-custody everything. Instead, she urges people to understand the trade-offs clearly, rather than assuming regulated equals safe. Safety, she explains, depends on the scenario you're trying to survive. As the conversation closes, Caitlin Long outlines what she sees as two possible paths forward. In one future, Bitcoin becomes fully financialized, absorbed into the existing system, and used primarily as a speculative instrument with limited monetary impact. In the other, periodic stress events force a repricing of settlement risk, pushing value back toward real Bitcoin held outside the system. She believes both paths may coexist for a time, but history suggests they cannot remain balanced indefinitely. Eventually, claims and collateral diverge, and the market is forced to choose which one matters. And that is the core warning Caitlin leaves listeners with. Bitcoin does not fail because it is volatile. It fails only if people forget why it was created in the first place.